Good morning. Welcome to America First Wealth Management Investment Outlook for July 22nd. My name is Dan Liu, Chief Investment Officer and Portfolio Manager at America First Wealth Management. Joining me is Micheal Cheah, our fixed income manager, head of fixed income and portfolio manager. Next slide, Mike. This is our standard disclaimer. I'm not going to read it, and just basically says that we're not giving you any investment advice or recommendations. We're just giving you our outlook on the markets and commentary on what happened in the past week and what we think is going to be happening in the near term. Next slide, Mike. So the big news occurred on Sunday. President Joe Biden dropped out of the presidential race, submitted a letter to Congress saying that he will finish out his term, but he is bowing out of the presidential race. He has endorsed Vice President Kamala Harris to be the nominee. However, that will not be official until the Democratic National Convention meets in August and officially appoints a nominee. This has never occurred in the past, at least this late in the election cycle. This is after the Democratic primaries. So all the delegates that have been selected to cast their vote cannot cast their vote for Joe Biden, obviously. So they will have to cast for a new candidate. So it kind of adds a lot of uncertainty into the markets right now. And there'll be a lot of jockeying to see who becomes the nominee. So it does add a degree of uncertainty to the markets. And we'll be very curious to see how the markets react to it. Next slide, Mike. Big problem happened on Friday morning. A lot of computer systems and users woke up and saw the blue screen of death. And that was caused by the largest cybersecurity company, CrowdStrike, who implemented what they called a routine update early morning Friday. Obviously, it wasn't so routine because it caused a lot of systems to crash. A lot of airlines weren't able to fly. Hospitals were impacted. A lot of surgical procedures were canceled. Transportation networks were down. It was a big mess. Fortunately, it wasn't a cybersecurity hack. And a lot of systems were able to recover, but it just created chaos. And I think what it will do is cause a lot of companies to reassess their cybersecurity and systems, and probably realize that they can't have all their eggs in one basket. They can't be 100% reliant on Microsoft servers to run their systems. And I think they'll probably have to look at other software like Linux or Apple. So look for a lot of companies to reassess their systems. And I think that's going to create a lot of changes in budgeting for IT next year. So it's kind of, it was a big headache. Fortunately, it wasn't as severe or as extended, and systems recovered. But it does cast a question mark in terms of how companies spend their money and go forward in terms of their planning. Next slide, Mike. In terms of weekly market stats, we had a large sell-off among the large cap stocks, and the S&P 500 was down, and also tech was down in a big way too. NASDAQ and NASDAQ 100 were down over 2%. And growth stocks, large growth was down 4%, over 4% for the week. Market bought small caps and large value stocks. As you can see, Russell 2000 was up 1.5%. Russell 1000 was up 0.65. International stocks were sold off. ETH was down 2.5%. And bonds were down 35 basis points. Dow Jones Industrial Average was up slightly, 0.72%. It was a tumultuous week, and I think a lot of the small cap action, I think, was driven by large call option buying in the uh, IWN, which I think is the Russell 2000 ETF. So I think that large call option buying drove the Russell 2000 index up. So it remains to be seen if the cash flow continues to go into small cap, but it was a dramatic move, and we'll see if it continues. If it does, it represents a broadening shift at the expense of large growth and technology. So to me, that would be a little bullish if that continues to happen, as long as the larger cap indexes don't get drawn down in a large way. So hopefully that'll stabilize and we get some broadening among the smaller cap stocks, but we'll see what happens. Next slide, Mike. The 10-year Treasury yield rose 7 basis points for the week. And as in the past, I put the 10-day moving average, which is the dotted line here. And you can see now the 10-year Treasury yield is now above the 10-day moving average. So it's kind of bearish for yield. It's kind of lost its bullish dropping that we've seen. I'm sure you're going to comment a bit more about that, Mike, in terms of the action there. So we'll shift it over to you, Mike.
Okay, thanks, Dan. All right, look at the economy. Here we have a chart that shows the dark line, ISM manufacturing PMI, which has been declining with a slight bounce. And compare that with the percentage of rising regional Fed manufacturing survey. This cover New York, Philly, Richmond, Chicago, Dallas, and Kansas. So as you can visually surmise from this chart, the red line, okay, more and more of the regional Fed surveys are showing strength, and question is, will this turn down or the ISM manufacturing PMI turn up, right? So, well, it wouldn't surprise me. It would surprise me that we see a rebound in the PMI numbers that have been hovering on a weak level recently. And here you have 5 of the 12 Fed district report flat or declining economic activity, according to the page book. So what this means is that 7 of the 12 are seeing stronger growth. And here we have the visual activity index dip, but it's far from recessionary territory. So we have a drop here. And as you can see, in the past, when we're in a recession, this index goes below 0. We have a brief false drop here, and now we are comfortably above recession level. So all in, the economy is doing reasonably well, right? Which suggests that the Fed may not have the luxury to rush out to cut rate. And if they look at this chart, according to the University of Michigan survey, the mean, right, 5 to 10-year inflation expectation is kind of shocking, right? Kind of shocking. And meanwhile, the median is hanging around the 3% level. So, the Fed talked about needing to look for sustained, looking for data that would point to sustained improvement in inflation. So this is not the evidence that they're looking for. And the other interesting thing is the metals and mining sector, right, is coiling, and this is where the money is, right? People are buying this sector, and if we do break up, right, this may suggest that the investors there are seeing something that we are not yet seeing in the inflation numbers. After all, right, higher metal and mineral prices would lead to a strong underlying inflation pressure. Right. Similarly, the oil sector have turned around, and now we are breaking up. Okay, so I watch all these energy and minerals, metals, commodities as an indication of what the market is saying about inflation. Another interesting aspect about inflation is that the capacity utilization rate has been declining, but recently it has made a turn up, right? And while we are not in the 80% territory, that will give the companies the luxury to raise prices. We are at the same time not in disinflationary environment that we thought we were heading towards, right? And a little bit more on the beige book. And if you look at the word count, right, inflation has stayed stubborn. And meanwhile, there's a pickup in the worries over supply and supply chain. Okay. What else do we have? Well, they also did talk about and discuss about slowdown and recession. So I would surmise that they are 50-50, right? They are mixed, right? The opinion mixed. There's no clear evidence that there's enough concern to move towards cutting rate at this stage. The other thing that surprised me a lot is that while we focus quite narrowly on whether the Fed will raise or cut Fed funds rate, the reality is that in terms of overall liquidity, liquidity is driven by a lot of factors aside from just Fed funds rate. We have to take into account of the strength of the dollar, take into account of risk on, risk off, banks lending standard, and the spread in the market, the animal spirit. So what this chart says is that the overall financial condition is loose. It's loose. That means that despite a tight monetary policy, the overall liquidity is plentiful, right? So does it make it easy for the Fed to want to add on to this and make it even easier and risk allowing inflation to reaccelerate? Maybe not. So I think they would want to be cautious, right? Knowing or observing the possibility that the market is still flush with a lot of liquidity. Bond market, I'm constantly looking for this yellow bird, the canary in the coal mine. And according to this analysis, the last time the triple C and the single B diverged, it was the dot-com warning. So this was it, right? The CCC, the blue color went up, while the dark blue single B came down, right? And we are beginning to see this slight uptick here with a continuous decline in the single B, right? I interpret this as money leaving the riskier CCC, going into the relatively stronger single B, right? So money leaving the weaker sector, moving in the stronger sector. So this kind of thing can be self-fulfilling in the sense that when more money leaves the sector, then the triple C would be would face a tighter liquidity situation. And when money is less available, chances of somebody filing for bankruptcy goes up. Right? So we're going to watch out for this. And here is a reminder on why I am still expecting the long end of US interest rate, the treasury yield to go up because of the rather weak sponsorship from the foreign holders, right? So as you can see here, foreign holders used to buy about 34% of the total outstanding US Treasury securities, went down to 22 and recovering somewhat to about 23.5%, right? All right, then over to you.
Yeah, mute myself. Okay, so I pulled out two slides that I thought were interesting. I called them wall factors. If you can switch the slide, Mike.
Oh yeah,
Next slide.
sorry, drew
This I thought was interesting. The household debt as a share of household net worth is very low. It's we haven't seen these levels in terms of household balance sheet since the 70s pretty much. So it's a very healthy household balance sheet in terms of household debt. We're not talking about credit card debt. Credit card debt is a different animal. I think last week I showed that the delinquencies on credit card debt were rising, but that tends to be a lower credit quality population. But in terms of overall household net worth, this is a very bullish chart to me, and I think you would agree, Mike, that most households just have very strong balance sheets. Next slide, Mike.
Yeah. Oh, just let me add on that
Yeah.
the household that have borrowed money, the big ticket item, mortgages, many of them were able to lock in at the very low rate during COVID, 3.5. So in terms of the debt, but in terms of the interest payment that they have to pay, it's not that big a deal compared to the last time the Fed raised interest rate.
Mm-hmm. Good point. Okay, these two charts, sorry, it's a little hard to see, but the top chart shows that a record high 30% of the population has a stock market portfolio worth more than $500,000. That's a very high percentage, and you see the horizontal bar, I'm sorry, vertical bar also marks where the Fed starts hiking. So even despite the Fed rate hikes, stock market, as we know, has continued to rise. But 30% of population having a portfolio worth more than $500,000, that's pretty significant. The bottom chart shows that 37% of the population has a home worth more than $500,000. So that's another very strong indication. If you add in the stock portfolios and the real estate portfolios, you could probably argue that about 30% of population has a stock and home value worth in excess of $1 million. So that's very healthy, combined with the previous chart I showed. It just says to me that large pockets of the population do have a very strong balance sheet and very strong asset base. Next slide, Mike.
And this kind of data is something that so much higher compared to the earlier years in 2005 and 1998. So perhaps this explains why TSA is reporting that more people are flying, right? Is there any impact any impact of this on the discretionary stock?
Well, it kind of depends. If you look at some of the stocks, like for example, the cruise line stocks have had a huge rebound. I think
Mm,
much of that was post-COVID um, pent up demand and
yeah.
it's picked up, but the last few earnings calls, bookings were very strong, and I think that bodes pretty well. You have to remember your typical cruisers tend to be older older people, so that kind of
Mm,
is probably reflective of baby boom generation spending. Whereas you look at um, restaurants, consumer discretionary stocks, um, retail stocks, they're under pressure. The nuts, and part of that could be um, competition from Amazon and just the big box stores like Costco and Walmart that just have so much more significant operating leverage and market share power. But a lot of the smaller companies are hurting. Um, so it's kind of a mixed bag if you look at it. But if you can, I think there's some good stock picking opportunities in discretionary stocks. But you got to be careful because I would probably argue that a lot of your triple C rated debt belongs in the consumer discretionary space.
mm,
So
mm,
but there will be some opportunities. There will be survivors, and there'll be some companies that will lag. Um, when you look at among other discretionary stocks, so if you look at the casino stocks, you know, there's too much supply of casinos. That's a
mm,
problem there. So it's a mixed bag in terms of performance there. Um, but it kind of depends on um, what people are spending their money on. What I'm looking at closely is to see an uptick in new automobile buying. And I haven't seen a huge uptick in auto buying yet. And some of it's distorted by electric vehicles versus um, ICE engines or hybrids, but I don't see an overall strength in auto buying. And I think part of it is a lot of auto buying is driven by interest rates. So interest rates being higher makes it
mm,
harder for people to finance auto purchases. So it's hard to say whether or not the overall consumer and consumer discretionary spend is healthy. There's just a lot of headwinds, but I think if you look at if you there are opportunities, you just have to pick the right areas to be, and I think any uh any trends that we're seeing seem to be a little short-lived. So we'll just have to wait and see. I'm waiting also to see if home building and new housing permits pick up, because that would be evidence of a younger generation
mm,
realizing that it's time to get married, start the home, um, have kids. And when you look at it, when I bought my first house, I think my first mortgage was 12%.
wow, that's crazy.
So, if you look at rates now, people are crying about a, 7% mortgage rate. Well, look, my first house was 12%. And uh, you know, and things go up and things go down, but there comes a time when you realize you have to get married and start a family, and you know,
Yeah.
you're forced to do these things. So hopefully that same pressure will occur, and we'll see a younger generation benefit from that. And ultimately the older generations will realize that they have too much house. They they want to retire, go somewhere where life is simpler, and downsize. So that will ultimately have an impact on supply, um, regardless of what interest rates are, in my opinion. But
Yeah.
obviously interest rates can help move things a lot quicker, and we'll see. I wanted to point out that I listened to an interview that Donald Trump gave to Bloomberg. And this was before the assassination attempt, and also before, obviously, Biden announced his decision not to run. what Trump had said regarding Jerome Powell, he said that he's likely to allow Powell to finish out his term, which runs into 2026. But he also warned that he better not cut interest rates in September because Trump felt that he didn't want the Fed to artificially stimulate the economy of the stock markets to alter the perception of the population when they vote. But now that the events have changed, I think who knows how Trump is thinking about it, who knows how new candidates may be thinking about it, and who knows how Powell may be thinking about it. You have your view on inflation being sticky and cutting rates now would not be beneficial, but we'll see. Maybe the Fed does see through a better crystal ball than you and I see, but it'll be interesting. September will be a very important decision point for the FOMC meeting, I believe. Okay.
Yeah.
Okay, getting back on track. As I've been showing previous weeks, the Magnificent Seven names, they got hit pretty hard last week, obviously. The previous leader, NVIDIA, down 8.75%, Amazon down 5.8%, and you can see all the rest of them all in the red. And months to date, the only name that's up is Tesla and Apple. And quarter to date, which is the same as months to date, actually. But for the year to date, still all positive except for Tesla. We'll see if there's a rebound in the Magnificent Seven. I believe it's going to be driven by earnings, which I'll talk about later, because that's going to be I think the gating factor and what the companies say regarding their outlook. That's going to be important. Oop. Next slide, Mike. Got to click slideshow.
Yeah, right. Yeah.
Okay. Turning to the sector performance. And you mentioned before the XLE obviously up, which is the select energy stocks among the S&P 500 names, up 2.04%. Now, I believe that's more a function of Trump's, the post-Trump assassination attempt and his Republican National Committee convention acceptance speech of his nomination. And we all heard him literally scream, day one, he's going to drill, baby, drill in the energy sector. So I think that that rally cry lifted energy stocks, which is why it was the top performing sector for the week. Flipping to the bottom, as you can see, technology sold off, which we talked about. Real estate was number 2 sector for the week. I think it was driven by the home building stocks, which have seen some increased demand with the slight drop in interest rates. And I think there's some seasonal demand as well. Financial stocks were up 1%, 1.1% for the week. Consumer staples were up as well. Industrials are up a little bit. Rest of the sectors were down. But again, you see technology down the most and consumer discretionary also being weak. Next slide, Mike. In terms of the qualitative and style factors, which we like to track to kind of highlight if there's any qualitative things going on, buybacks. Buybacks stocks did well for the week, as well as spinoffs. But other qualitative factors did not perform well. Among the style factors, obviously small caps up a lot because of the run-up in the Russell 2000. High dividend stocks also did well, and value stocks, which we talked about. Momentum and growth got slammed as we talked about. And that's it for factor performance. Mike, next slide.
Mm.
Turning to commodities, we had a big sell-off on virtually all the commodities except for coal being up slightly, which was kind of interesting. And we'll see if this continues. They've been very volatile. You know, we've seen gold hitting, I think, record highs and then pulling back towards the end of the week. I don't know if it's trading manipulation or just your normal volatility, but there was just a lot of dramatic action. And, you know, so I think that's kind of very very volatile. I'm kind of a little confused by the action. You'd kind of think that there'd be more of an increase in demand, especially from precious metals. You know, as you've noted, the treasury bond holdings from foreign investors, foreign countries have been dropping, and we've seen the big uptick in gold buying by central banks. So that might just be an opportunity with the drop in gold that we saw last week. Next slide, Mike. And for agricultural commodities, lumber was up big, 14.94%, and might be from a pickup in home building activity, but that's a pretty dramatic move there. And it might also be from some droughts that have been reported in some parts of the country. All right, next slide, Mike. Turning to the economic data that's coming up for the week, Monday's pretty light. Tuesday, we're going to have some home sales information, manufacturing data. Next slide, Mike. Wednesday is typically the biggest day in terms of data, mortgage rate applications, mortgage rate information, crude oil data. I won't read it all. Next slide, Mike. Thursday, highlighted in red, durable goods and GDP growth rate. Those would be important data items there. So we'll watch for that pretty carefully. That'll definitely be interest rate moving as we look for evidence of growth. And here it's kind of the old good news is bad news. Good data is bad for interest rates. Next slide, Mike. Friday, we have your core PCE price index, which will be a big item, personal income and personal spending. So those are things we're going to watch. Those will definitely have an impact on interest rates and consumer discretionary as well as stocks. Next slide, Mike. So we get a lot of earnings this week, and I thought rather than try to show them all because there's quite a bit, I think nearly 100 stocks are reporting, 100 companies are reporting this week. I thought I'd limit it to the larger companies, over 100 billion market cap, so we can have a more manageable list. And I think these will be the companies that are will be driving the market versus some of the smaller companies. Next slide, Mike. Starting off on Monday, pre-market, we've got Verizon. And then Tuesday, pre-market, Comcast, Danaher, GE, Lockheed, Coca-Cola, and UPS. And what I show here also is consensus earnings and versus a year ago. In the past, I just showed the year ago number. Just thought it'd make the math easier, just do the calculation to see if the earnings growth is higher or lower. So you can see Monday, Tuesday, most of these stocks are looking for lower earnings versus a year ago. Next slide, Mike. Tuesday aftermarket, the big one being Alphabet, the old Google. We're looking for $1.84, 40 cents higher. I'm sorry, that should not say 1 year ago, it should say versus 1 year ago. It's looking for 40 cents higher earnings. At Chubb, we have Tesla. Tesla is looking at down earnings, 62 cents. That's down 29 cents, down 29 cents from a year ago. Got Texas Instruments, Visa, Philip Morris, Wednesday pre-market, AT&T, Boston Scientific, Nexera Energy was a big utility company in Florida. And that'll be an interesting one to listen to a commentary in terms of what they're saying about data center demand, which Mike, you talked about previously. So we're looking, so that'll be an important one for the utility stocks. Thermo Fisher was a big biotech equipment and medical equipment, medical diagnostic equipment company. That's a bellwether company in the biotech space that we like to see what they're saying about biotech spending and pharmaceutical drug spending on research. Next slide, Mike. Wednesday pre-market, AT&T, Boston Scientific. Oh, am I repeating that?
Yeah.
I
Well,
repeated it. Okay, next.
yeah,
Good have dropped a bomb. Yeah, sorry about that.
mm,
I'll have to correct it. And by the way, we make these slides available for anyone who's interested in receiving them, but I will correct this and I apologize for the error here. Wednesday aftermarket, KLA Corp, which is one of the leading semiconductor capital equipment companies, and we'll be very interested in what they say regarding potential U.S. policy uh, regarding limitations of their equipment going to especially to Chinese companies. And this had a negative impact on semiconductor stocks and the equipment companies last week, as the Biden administration had indicated that they were clamping down on semiconductor companies and equipment companies from selling chips and equipment to China. It'll be very interesting what companies start to talk about in their dealings with the political situation. And then we have ServiceNow and IBM reporting. And I think one thing you can see is a trend, I think you'll probably see with the tech companies, earnings versus a year ago tending to be a lot higher because they tend to or have been showing much higher growth. And I think some of the nervousness pre-earnings and the sell-off is investors are expecting these companies to temper their growth expectations. So we'll see if these companies do that. And if so, then the sell-off may be ahead of the reality. So be interesting if after the companies report and talk about it, if the tech companies rebound, that'll be a healthy move, in my opinion. Next slide, Mike. And AbbVie is another big biopharmaceutical company. They're looking at down earnings. This is down 21 cents from a year ago. Expectation 270. Honeywell, RTX, Union Pacific. Lam Research is another semiconductor capital equipment company. Looking for big earnings there, 758, up 160 from a year ago. And last but not least is consumer staples company, Procter & Gamble. All right, next slide. And I think we're coming to the end. As always, if anyone would like to set up a call with Mike or myself or find out more information about our products and services, please contact Cleveland Ashley, our regional director. His contact information is listed here. So thanks everyone for tuning in. And the news has been quite interesting, quite dramatic. We follow it with our usual analytical abilities and experience, and we've seen a lot of interesting things over the years, Mike. You know, you and I are our veterans and our team collectively has over 100 years of experience. We've seen a lot of interesting things, and some things kind of change, some things remain the same, lots of things rhyme. Uh, and like I've said before in the past, this market looks like the markets of the 70s with the nifty 50s, rising interest rates, rising inflation, um, political crisis. It kind of rhymes a lot with that. And, be very interesting to see how we come out of it. If we have continued inflation and continued higher interest rates, and tougher times ahead, or if it gets better, or if maybe we get through this one, and hopefully the Fed will do the right thing, the political leadership will do the right thing. But I think investors, in my opinion, it's probably a good time to have some dry powder and wait for a better opportunity for greater upside. Uh, Stocks aren't overvalued, in my opinion, but it's probably a good time to be a little cautious going into earnings, going into fall and the election season. Wait for the news, wait for policies to be established, and just so we know where things are heading on a more stable basis. And I'm probably giving some insight in terms of our positioning. Uh, we've gotten a bit more defensive here. We've raised some cash, and we are cautious. We want to see, the news and the policy statements and the rhetoric calm down a bit. We want to have a better sense of where we're going before we take the big bets and the large position. And that's what we're doing with our clients' assets. That's how we're looking at things. So, Mike, anything you want to add before we sign
Yeah,
off?
as we move into end of July, August, let's try to squeeze in a holiday or a cruise, right? Before we get back to work in the office.
Right. Enjoy the rest of the summer, everyone.
And we're here to help.
Okay. Take care, everyone. Thanks for tuning in.
Bye
Bye-bye.
bye.